Hi everyone, it's Jack Bauer in another video. Today I'm doing a stock analysis on Realty Income Corp, which is probably the most famous REIT around. Most famously, it's a monthly dividend payer, probably the most famous monthly dividend payer. It's required, as a REIT, a real estate investment trust, it's required to distribute its earnings, its profits as dividends. Down 5% year to date in a wider market crash, which is excellent, outperforming the S&P this year, which is down to like 18 or 20% as we speak. And this is probably because of its inherent safety and the safety of dividends, and that it's typically done well in times of rising interest rates and in times of recession. 10% or so away from its all-time highs. I want to establish if it's a buy right now or if it's still a bit overvalued. As you can see by this graph, the dividend track record of this company is extremely impressive. It's a dividend aristocrat. Since going public in 1994, it's had 115 dividend increases, 98 consecutive quarterly increases, increased dividend every year it's been on the public market. Compound average annual growth rate of approximately 4.4%, which is reasonable for this space as they're growing into about 5% a year. Dividend pay for 53 years, over $9.3 billion. Their annualized dividends have grew from 1994 90 cents to now $2.96, so that's over tripled in 30 years. Well, in less than 30 years. Not overly impressive growth, not freakish growth, but over time that is really impressive, and it's growing on a quarterly basis, so that's really going to compound over the long term. So the strength of this dividend and the track record only complements the incredible track record of this company. One of the 65 companies that's an S&P 500 dividend aristocrat. It's a top 10 global REIT. It's actually the 5th in the world at the minute, I believe. It's already in the top 5. 15.3% compound annual total shareholder return since public listing in 1994. Absolutely incredible. 15% growth a year on your money effectively, which is wonderful returns over the long term. 4.4% compound annual dividend growth rate since 1994. 115 dividend increases, 98 consecutive quarterly. Absolutely excellent. Where they want to be, or where they believe they're going, to be a top 5 global REIT, which, as I said, I believe they're number 5 right now, to consolidate the $12 trillion global net lease addressable market, which they only have a very small amount of as it stands, to average double-digit total shareholder return with minimal volatility. Essentially, they want to beat the S&P 500 going forward, which if you average double-digit returns, traditionally you should do. S&P averages around 8 or 9%. And to continue treating the dividend as sacrosanct to our mission. Essentially, they want to pay this dividend regardless. It is the absolute most important thing to them, as well as being a sustainable, profitable business. And that is excellent for income investors, for dividend growth investors. This is exactly what you wanted to be hearing from a company like this. I've knew about this company for a really long time, but I saw a graphic recently that's on the screen that's really impressed me and attracted me even more to this business, in that in the last series of Fed rate hikes, when the Fed began raising its benchmark interest rate from December 2015 to 2018, it went from 0.25% to 2.5%, so that's a tenfold increase. It outperformed the market dramatically, a 44.4% return in that time compared to 30.6% for the S&P 500. The Federal Reserve seems to be entering another cycle of interest rate rises. The interest rates are almost certainly going to increase over the near term, probably towards that 2.5% rate, if not higher. Realty Income outperformed this and the MSCI US REIT Index over the 3-year duration of that cycle, and I believe that they will do it again. Of course, I can't guarantee this, but historically they have performed very well when short-term yields are increased. What makes the now 4.4% dividend yield so protected is that the real estate portfolio is incredibly well diversified. They have 1,090 clients across 70 industries, across 50 states of the US, Puerto Rico, Spain and the UK. They have a growing presence in Europe, but it's not really anything to shout about. 5.1 billion European portfolio compared to the wider portfolio, that's not a lot. Their enterprise value is $57 billion, market cap currently is $41 billion. They have $3 billion in annualized base rent, a very, very strong credit rating from Moody's and S&P of A3 and A-. 43% of the rent is from investment grade clients, which is exactly what you want to see, and they have over 11,000 properties across 53 years of operating its history behind them. 11,000 properties across 70 industries, incredibly well diversified, a lot of clients. Any one client is not going to hurt them particularly well, and they have such a strong track record to back this up, and are expanding into other countries. So a market crash in the US, for example, a localized recession in the US, which in reality is going to cause a recession worldwide, but a localized recession in, say, the UK is not going to hurt Realty too much because they're so diversified in what is a highly fragmented market. As you can see from a list of their top clients, you've got big multinational companies here, blue chip companies, Walgreens, 7-Eleven, FedEx, Dollar Tree, Sainsbury's, which is a UK-based retailer, B&Q, which is again UK-based retailer, as is Tesco, Home Depot, Tractor Supply, CVS, Walmart. These are enormous companies, and importantly, none of them is above 4% of the annualized rental revenue. Increasing that diversification, customer concentration will be a real worry here and could really hurt the revenue growth, which is not a lot every year. The single-digit revenue growth. If they were to lose one of these customers' leases, if they lost all the Walgreens locations, for example, which is extremely unlikely to happen. But let's say Walgreens went under, they'll lose 4% of the revenue, which will be very tough for the business. But importantly, there's not a lot of customer concentration here. If that number was 10%, that could be catastrophic for the stock and the business, but that is not the case here. They're extremely well diversified, and of course, they have over 1,000 clients. These are just the top 10 or so, so there's a lot more with a very, very small percentage of the portfolio, but they're still providing a large amount of the revenue. Obviously, the global net lease market is absolutely immense. The opportunity here, potentially $8 trillion, they believe, but I'm sure there's a lot of projection here, and it's really hard to know the true amount, but it is definitely beginning with a T. It'll be in the trillions for sure. They believe that Europe is the clear location where they'll be able to generate growth. The public net lease REITs account for 4% of the total addressable universe, $160 billion in the United States, $7 billion in Europe. To achieve similar market saturation, they believe that Realty Income's enterprise value in Europe would approximate $115 billion to achieve similar market saturation as they have in the United States, which will be 22 times the current portfolio size. Obviously a lot of projection here, but there's definitely potential for them to grow in Europe and match what they've done in the United States. You see they're already doing that to some extent with the likes of Tesco, Sainsbury's and B&Q, which are major brands in the UK, all having a lot of leases as part of Realty, and I can believe they continue to expand rapidly in Europe. It would definitely concern me if this growth was not approached in a sustainable and sensible way. As you can see from 2019, this is where they really started to ramp up the source volume internationally. $57 billion in 2019 of total source volume. You can see that percentage in the lighter shade of blue. A decent amount of that was international, and that is only growing as a percentage. You can see in 2021, it looks probably about 65-35 of that $84 billion, and they're considering to spend a lot they consider to see a lot of source volume going internationally more and more because they're reaching market saturation in the US, which is not so much of a problem. Their acquisition volume, they tend to have a high selectivity rate, so single-digit selectivity most years, except in 2010 when you can imagine a lot of things were on sale because of the Great Recession. But typically low selectivity because they are a selective company. They only want the absolute premium locations where they can generate the most effective profits and have long-term leases. Acquisition volume tends to be in the single-digit billions every year. Again, sustainable rate. You're looking under $2 billion most years up until 2019, 2020 and 2021, where there'll have been a lot of opportunities. $6.4 billion in 2021, so clearly a lot of commercial real estate available post-pandemic. They're capitalising on this, and a lot of that will have been in Europe to fund its future expansion. I really like how it's doing this. I think this will provide sustainable growth for this company for the long term. I think this strategy is absolutely wonderful for the long-term health of this company. REITs are a bit more difficult to value than typical companies. P/E ratio of 65.72, very high, pretty poor for the industry, but again, this is the absolute premium REIT in this industry in my opinion, so I would expect it to be high, but poor for Realty's history. That's on a trailing basis. On a forward basis, 40, which is again poor for the industry and pretty poor for Realty Income's historical valuations. Price to book ratio, 1.59, not very good for the industry. They typically trade much closer to 1. But for this company, which is typically held at a premium, this is actually quite a good number. It can trade more towards 2. So this is, on this type of basis, this is relatively cheap. Price to free cash flow of just shy of 20. Not ridiculously expensive, not ridiculously cheap either. This is kind of middle ground. I'm by no means saying this company is a bargain, but this is exactly the type of company that people retire on, that you can put faith in that it will return year after year, or if it executes well. And that is exactly the type of thing you want a dollar cost average into, and so the stock price doesn't matter so much over long term. But if you can pick this up cheaply, like for example in 2020 when it was around in the 40s, that you can get incredible returns. So to summarise, not obviously cheap of course, but companies like this that have consistent returns, that are a relatively safe place for the money, even in these type of markets, it's only gone down 5%. They're very rarely going to look cheap because it's a place of inherent safety. Monthly dividends are such a premium. 4.4% dividend yield, growing every year, going every quarter actually on a monthly basis. You get money in your pocket. These type of stocks are always going to trade at an enormous premium. 40p is expensive. 1.6 times price to book is not cheap by any means. But in the grand scheme of things, people are paying for safety. I completely agree with that. I do have a small position in Realty Income that I'd like to dollar cost average into over time. I think right now is an okay price to pay for Realty Income. Not the best, not the worst. I prefer to pay for it if it comes down a bit, which I think it may do in the near future. But it's typically performed well in times of higher interest rate environment. So I can't see it suffering a massive loss like it did in 2020 when so many office places were closing. That was a real freak event. So I don't think it's going to drop into the 50s anytime soon. But if it went under $60, I'll be buying rapidly. And any lower than that, I'll be buying even more. Of course, this is not financial advice. You should not take it as such, at least not directly anyway. You should do your own research and due diligence, not just listen to what I say. Let me know what you think of Realty down below. Let me know if you're using it for passive income, for retirement, just to build up because you believe in the stock. Whatever, let me know what you think of the company down below. And if you're enjoying the videos, please like and subscribe. I'll see you again next time.